Hey everybody, welcome back to another edition, another breakdown of open interest. We're going to spend some time talking about my post today. I'm going to be working on this basically now that I've been indefinitely suspended from Reddit. I'm going to be using these videos as an opportunity to break down some of my analytics, to basically walk you through some of my thought structure, the things that I'm looking at. Hopefully in this way, right, I can present some of these elements that I look at on a regular basis, right? I can help clarify some of these concepts and impart some of these models that I'm working with, and I mean that way I can get better at talking about them. I can get better thinking through them, and hopefully some of you out there can get a clearer sense of where I'm coming from when I think through some of this stuff. So let's get right into it. Let's head over to my post. So for reference, right, I post these every day over on Twitter. And today's is up. So today's title of today's post is Arcade just saved the company millions. Yes. So this is what I'm saying here. This is my hypothesis here. What was this particular move? Like, what was the purpose of this tweet from Roaring Kitty that came out yesterday from Keith Gill, right? The U cover from 2006, the time U cover, maybe a cryptic message to shorts. I think most likely a cryptic message to some of these more manipulative shorts that we've seen enter into GameStop over the past few days. What was the purpose of this? Like, why drop a tweet, yesterday? Why not today? Why not Friday, right? Why not wait until next week immediately before earnings? What was going on? So we're going to spend some time thinking about that today. Basically, the gist of what I get to here, you can see me walk through more of this in the actual post. But basically, right, we were looking at this setup here, this clash of regression channels. We were looking at this broader, larger bullish regression channel, this upward trend that we've been looking at. Bounded at its absolute lowest by the 104-hour moving average on GameStop, right? So if you take a look at the chart, you can see the overlap there of that orange line is the 104-hour moving average, and you can see it lining up just nicely with that the lower bound of our upper regression channel. So basically, right, we had this major uptrend going on over the past month, I guess going on about 5 weeks now. But then all of a sudden after Thanksgiving, right, we see this sub channel kind of just start to reject us, just push us out of this trend, right? And so, okay, there are, right, when you're looking at big upward trends like this, like there are these bearish sub trends that develop within them as sort of part of this regression within the regression channel. But what we started to see take place during trading yesterday was we started to see measures, some selective measures by unknown, likely institutional players trying to force us out of this bullish channel. We notice this happening through manipulative shorting, taking 100,000, 200,000 shares and just dumping them on the tape. Okay, people can do that, right? That's, we don't necessarily like that, right? Individual retail investors typically can't do that, right? We can't just throw around 200,000 shares. So, that tends to irk people, but like, okay, that's kind of a feature of the market in a certain sense. I mean, there are issues with short selling in general that I take philosophically, but that's a video maybe for this weekend or something like that. But other things too, right? So fine, you're going to allow 100,000, 200,000 shares to get borrowed from out in the ether and then dumped on the tape. Fine, right? But then we also saw that yesterday was paired with some pretty manipulative order rerouting. So we had a big whale order come in, right? We had an order for 144,000 shares come in about 3:05 p.m. During what was this on Tuesdays? No, excuse me, on Wednesday's trading. And this order, unlike a short order earlier in the day that hit the tape, this order was routed to a dark pool. So it did not actually go through the lit market. The demand of that order did not get moved into the lit market as a whole. And so the counter demand to that bearish earlier short selling excess of supply didn't equal out. And so we saw ourselves get ejected from this bullish channel. Early in the trading yesterday, we saw some pretty clear fights on the part of bears and bulls. Traders, institutions trying to sort of angle here to get us back into this bullish channel, right? I talked about this being the case yesterday. We can zoom in a bit, right? We take a look at sort of my chart right up here, right? So we saw in the pre-market, we saw this purposeful intent to push the price up to try to reclaim our bullish channel. We can see that basically about 30 to 40 minutes into the trading day, the price traded up into this sort of arbitrage zone between these two regression channels, so the bearish channel and our bullish channel. And we got above the lower bound of the bullish channel, but we stayed largely below the upper bound of the bearish channel. Bears were able to move this thing around in such a way. They built up a head and shoulders pattern. This signals to day traders, bear head and shoulders pattern. I know what that means. That means when we get to the other side, it's going to fall. It's going to go down. Sure enough, we got some of that. It really looked like bears basically were in control for the day. Now, you recall in my post yesterday, right, we had this buildup of put gamma, so put gamma exposure, I should say, right? So between our option strikes, $26.50, $26, $25.50, we had an excess of put contracts that market makers were exposed to, right? What this tends to do, this affects the way that market makers hedge those positions and hedge their risk with respect to those positions. So basically the properties of that are that when you have put gamma exposure dominant strikes, that the price tends to accelerate in the direction that it's already going when you are in the midst of that area. So by basically surrendering this bullish channel and moving more firmly into this bearish regression paradigm, we also, in terms of price, moved into that more slippery put gamma exposure dominant range and began to slip and slide down the chart, right? So if we take a look, all right, before Roaring Kitty's post here at 1:45 p.m., that's basically exactly what we saw, right? So if you take a look at the right, we had this arbitrage zone between the two channels, and then fade off. Market open, better get ready. Right, so this regression down here, and we just slide, right, kind of seesaw our way in here. Maybe we got a bit of short volume throughout the day to kind of push that further down the track. And really, we were looking at something like basically heading to something like $24.50, $25 kind of at most, even before earnings. Okay, so let's stop for a second and think, okay, why would bears like really want that? Why would they go through these measures to try to push the price down like that ahead of earnings? Like, doesn't the price get shorted like anyway? Like, doesn't that automatically happen a lot, right? We've looked, I've written about this before. 8 out of the last 10 earnings periods, GME gets shorted immediately out of earnings, regardless of what the sentiment, I guess, on the earnings report is. And 3 out of the last 4 quarter 3 earnings reports, so December earnings, GME gets shorted immediately out of earnings. The lone exception is actually 2023. So why go to this extent? Like, why do this before earnings? Like, isn't there this like effect, right? IV increases in the 2 weeks leading up to earnings. Like, why not just let the price kind of go up a bunch, and then, just before earnings, it's going to get shorted anyway. Why not just, dump a whole bunch of calls, like sell a whole bunch of calls on the way up there, get some, on this high IV, and then dump it and then exit your call? Like, why not do something like that if you're trying to make money? Okay. So this is where we may have a clue that these bears are not just, IV sellers. These are not just options traders. These are not just people with big options positions who, are just trying to make money at scale off of these movements. No, these are people who want to see the company do poorly for a longer period of time, who want to affect meaningful material change in the company by what they are doing on the lit market, by what they are doing to the stock, which is exactly the thesis, the issue, right? This was exactly what Michael Burry ended up writing to GME about back in 2019, right? This was the issue that it was very obvious with this seller boxing strategy that there were institutions, financial institutions, who had a material interest in seeing the company go bankrupt and were actively taking a role through excessive short selling to make that happen. Okay, what we see here is evidence of the exact same thing happening. At least it's suggested, right? I'm not a lawyer. I'm also not there looking at portfolios. I'm not there in the financial institutions watching this happen. But the coincidence of these factors taking place strongly suggests to me that this is the case. You might say, okay, Michael, why would you think about that? Why would you say that this is to materially affect the company? Okay, so over the past several quarters, at least since, let's say, I would say since the May-June sort of earnings period, right? This really big spike we had when Roaring Kitty came back to Twitter/X, that one of the strategies that Ryan Cohen has been pursuing is trying to find a way to extract money from these, let's say, legacy shorts, these synthetic short positions that have been internalized, moved around, failed to deliver, disguised through ETF creation redemption cycles that have been hidden in swaps, right? Part of the issue is, okay, this is moved around in such a way as to disguise, just like we saw on a smaller scale happen on Wednesday, right? To disguise, to limit, to kick down the road authentic and organic price discovery by having authentic demand, organic demand, basically routed away from the market, to have this artificial imbalance of supply from bearish trades and short selling, and demand from desire to buy the stock, right? To basically get these orders and get these pressures, redirected, right? So if you think about this, right? If you can find a way to kind of kick authentic demand sentiment down the road, you can kick true price discovery down the road. Okay, now Ryan Cohen has been pursuing a strategy of raising money during periods of high volume and high volatility when price levels are up, and in so doing has been able to extract a serious amount of funding from, you can call them legacy shorts, you can call them institutions who just get caught with their pants down, who can't internalize their trades during one of these moments of unexpected high volatility. What really is causing these? What are the real mechanical factors? Maybe it's got something to do with swaps. Maybe it's got something to do with actually reporting these positions. Maybe it's got something to do with FINRA. Like, who really knows, right? I'm sure there are people out there who have a clearer idea. I'm sure somebody like Keith Gill has a clearer idea of actually what's going on here. Clearly, the institutions themselves that are responsible for this do. But regardless of how this is happening, Ryan Cohen and the company have successfully been able to issue new shares, but in so doing, raise an amount of money that increases the valuation of the company at a rate that is disproportionate to the depreciation of the shares on the other side of that, right? So a lot of people say, oh my gosh, dilution, like he's diluting the company. Like you just saw today, right? We just got an announcement today that Adam Aron is diluting AMC again. Okay, what makes GME's dilutions different than AMC's dilutions? Okay, AMC is not a profitable company. Adam Aron has been going through these extensive dilutions in order to raise money to keep operations going, right? AMC currently has a burn rate that exceeds the actual revenues and incomes of the company. So the only way that AMC is staying afloat is by exploiting this meme stock sentiment, as it's called, by exploiting the fact that AMC happened to be, a similar company that was heavily shorted, that was in maybe one of these basket swaps with GME, that got sort of tied in, that had a real huge short squeeze back in 2021. And it's sort of been riding that legacy since then, and its connection to GameStop. Basically through these basket swaps. Okay, but GME is not like, right? GameStop is not like AMC. GameStop does not have a burn rate. GameStop is a profitable company. GameStop, okay, it's just getting out of the gates. Excuse me, in terms of its transformation. What's currently driving the company into profitable quarter after profitable quarter is that its interest from investments, largely through treasuries, treasury bonds through uninvested cash, or I should say, cash that's not used for operations, generates enough of a profit to offset operating cost expenses. So Ryan Cohen's been able to do these offerings to raise cash. It increases the profitability of the company through investment income. It creates a larger and larger supply of cash for the company to potentially go through a merger and acquisition, several mergers and acquisitions. It's certainly not in any risk of bankruptcy. So this is very different. The other thing that we've seen with these equity raises, these at-the-market offerings, people typically say, like, oh, dilution, like this is bearish. This is always bearish. Like means the price has got to go down. This is bad for the company. All right, well, if your company is AMC and you have a burn rate that just eats through these earnings, these at-the-market offerings, okay, that's bearish, right? Because you are a dying company at that point, and the only way you stay afloat is by begging other people for money. Okay, that's not what happens with GameStop. GameStop instead, okay, yes, you see this sell-off. Yes, you see the stock shorted. Yes, you increase all this supply so that immediately after the share offering, you see the price dip. But the floor after each successive offering continues to increase. So somebody like Richard Newton's talked about this a number of times on his channel. I'd highly recommend going and checking out his work. He's done over 500 streams, over 500 episodes talking about GameStop. I definitely, to go get more details on this, like definitely go check out Richard. He's like done all this stuff through, I think maybe probably like 50 or 60 episodes ago, maybe back around back around earnings for quarter two. So I want to say his video on like September 11th or September 12th or something like that. Go check out around there. He definitely has a really cool breakdown of like what prospective at the market offerings will mean for GameStop. So GameStop's price as a whole, right? Its trading range, its price range actually moves up every time that there is an at-the-market offering. Okay, so let's bring this all back, right? What does this actually have to do with Roaring Kitty and his tweet and shorting the company into the earning? Okay, if you know that Ryan Cohen is going to make this move, he's going with this at the market offering strategy. He's going with, let's call it the Tesla strategy, the Elon Musk strategy from 2019 to 2022, when Tesla went from whatever it was, like now post split, like, I don't know, $15 or $16 all the way up to $414, right? This is the strategy that Elon Musk used to extract money from his legacy shorts in Tesla over that period of time, once he had effectively transformed Tesla into a profitable company. Okay, Ryan Cohen is adopting this strategy. It's very clear that he is just going to keep doing this. Okay, so, but the amount of money that Ryan Cohen is able to raise for the company depends on two factors. One, it depends on what the stock price is at the time that he announces the offering, because that's at the market. That's the market rate. So if you're a short, if you're a bear and you don't want to see the company succeed and you can affect that, you want the company to raise less money every time there's an at-the-market offering. You want that share price to be as low as it could possibly be when Ryan Cohen makes that announcement. That's number one. Number two, the at-the-market offering, the number of shares that are issued during these share offerings depends upon the average volume around the time of the offering. So when we were back in May and June, right, when Keith made his return to X and posted his positions over on Superstonk, right, we were looking at 180 million shares a day, 350 million shares a day being traded on the open market. Okay, so that level of volume, that euphoria over over sort of, I don't know, let's call it algorithmic trading reactions to whatever Keith was posting on Twitter, increase the average volume to the point that Ryan Cohen could go out and offer. I think it ended up being, it was a 40 million and a 70 million share offering, right? So 110 million shares. I think it was 40. Wait, was it 40 or 45? I forget exactly, but at least 110. Maybe it was 115 million shares. All right, let's compare that to earnings. Earnings for quarter two, right? Earnings for quarter two, volume significantly lower, price significantly lower. Ryan Cohen still went through with a share offering to demonstrate his consistent intent to raise money during earnings periods and continue to build up the valuation of the company. The price was much lower and volume was much lower. So Ryan Cohen, quarter two, only raised $400 million, and he only did a 20 million share offering. Okay, 400 million still matters, right? This still is gonna benefit the company. I think it also sends a signal that, hey man, that wasn't a one-off thing, right? That May-June thing, that wasn't a one-off thing. This is the strategy. And this exact strategy is something that Keith Gill himself specifically talked about and described back in his live streams back in fall of 2020. He said that Ryan Cohen could adopt this type of strategy. It actually may have been a little bit later. I have to go refresh my memory on that. But in any case, Warren Kitty's known about this for a long time. He knows that Cohen knows that this is a potential strategy, right? Their Twitter exchange back in 2021 with symbols, right? There are two of them talking thing back in May and June. They're not colluding, but they're making their knowledge known to one another through this system of symbols, and through the moves that they're actually showing on the open market, right? We have to understand that for as much as we would like these memes to be communication, certainly to us to say, oh, pick this day or it's going to blow up here. It's going to blow. I mean, they do, right? I mean, they do talk to us. They do let the investor community know what's going on. Not very specifically. They don't divulge insider information, but they do send these little hints about information to the broader community. But it's important to remember that they're also communicating with one another, right? Roaring Kitty is perhaps the most important non-insider who is an investor in GameStop, there's clearly some form of indirect communication that's going on here with these moves to a certain extent. At least that's how I see it at present. So what does this mean then? What did Roaring Kitty do yesterday, right? Well, what he did was he ensured that through his tweet, he knows this, he's demonstrated this, he demonstrated this on his live stream back on his birthday back in June. Algorithms respond to what he does, right? They are programmed to put in halts, to move the price around, to control it, and use him as an excuse for the Wall Street machine to go ahead and manipulate the actual price, to control the price independent of market participant sentiment at large. Okay, so he knows that that's the effect. That's the effect of his tweets. He knows that, right? I mean, listen, all that Wall Street has to do is not have its algorithms go and respond to his tweets, but they won't do that because they make money off of trading his tweets instantly, right? Just as we saw yesterday, what happened around 145 when he had his tweet. Let's go down to the closer one here, right? 1.5 million shares in a second. Like, you know, it shows up as a minute candle, but like instantaneously 1 million shares got bought as soon as his post hit Twitter, hit X. So, right, this is not meme stock traders. Of course, now you look at, you see the news, right? We had something like, I saw some kind of Benzinga or something, you know, classically saying like, oh, here's how, right, where is this? Let me see if we can, was it with AMC? Yeah, I saw AMC also did a little thing. Yeah, here. Let me go over here. Let me share my screen here. I think I got to do the entire screen here. Yeah, it's got to be entire screen so you can see Thinkorswim. Right. Let's go over here on the Newswire. AMC, right? Something like where was it? It's like I just saw it. It's like how Roaring Kitty. Here it is. AMC stock is tumbling. How Roaring Kitty tried and failed to reignite the meme frenzy. Right. So, or Barron's. Okay, Barron's is also, you know, a piece of shit. So, yeah. Okay. So what we see, right? What we see clearly going on here is, you know, this effort on the part of these institutions on the mainstream media that colludes with them to basically say that like, oh, this is, you know, Keith Gill trying to just like pump these stocks. These are meme stocks. These are pump and dumps. Like this is, you know, these are like penny stocks. These are nonsense. This doesn't make any sense, right? And they've been trying to blame him for years as a culprit behind like organizing collective action to pump these stocks and then, you know, fleece other unsuspecting retail owners with a pump and dump scheme. Nonsense, right? So, you know, there's an effort here to have him particularly viewed in this particular way, but right, he recognizes that this is right. It's them who respond to him doing this, and then they go ahead and blame him, right? So, okay, so he did something like this, right? He dropped a tweet. The September 6th tweet was shortly before earnings. It was on a Friday. There was a big run up a gamma ramp. You know, our call gamma was built up in such a way that I wrote about this too, right? I remember posting. We had 2 Fridays back to back. We had a ton of Fridays actually like that back in September. But like, you know, call gamma was structured in such a way, it was carefully built out throughout the week that I basically was like, look, if like all institutions have to do is go like that, and then the price is going to go whoop. And you know, that's exactly what we saw back on September 6th when he posted that tweet. I mean, I didn't know he was going to post the tweet, but you know, I saw an order for like, I don't know, I saw orders that looked like Roaring Kitty come in. I posted about this. It's I have this elsewhere. I think I reference where I pointed this out in my article for today, in my analytics for today. So you can go check that out. But anyway, right. To sum this up, right? Clearly, what I think happened here is Roaring Kitty came in as the intervention necessary to push us back into this particular this bull channel that we were in, that we were organically occupying prior to these manipulative efforts by shorts to push us out of it, right? Organic sentiment. I mean, I was writing about this for weeks. Like, there was nothing but organic sentiment in terms of the options market to keep moving the price up within this channel. This was our technical paradigm. Traders were comfortable. We were seeing amazing call to put ratio, call to put gamma exposure ratios. Like, the options market was just like, let's keep going. Let's keep buying calls. Let's keep moving this thing up. There's no reason to, right? Organic sentiment was this thing should be higher. But as a result of these manipulative shorting tactics on Friday, on Monday, as we saw a little bit on Wednesday, a little bit more nuanced, this sentiment was ruined. This sentiment was disrupted. This plummeted the volume because it made sudden, like, traders like didn't know what was going on, uncertain. Are we going to be in this bullish paradigm? Are we going to be in this bearish paradigm? Like, how's this going to go? Like, we've got this negative gamma exposure environment underneath us. I don't know. I should start hedging my position. I should start selling short calls. I should way reduce my volume. I don't want to be taking day trades because this thing could just fall out from underneath us because there's still 1.1 million shares available to borrow. Right? These are the decisions that come in. So we saw options premiums dry up. We saw volume dry up. We saw volume going from like 13, 15 million shares a day fall all the way back down to 6 million, right? Okay, and then we saw the price basically looking like it was going to go $24.50, $25. All of that is stuff that materially hurts, would have hurt, I should say, Ryan Cohen's strategy to raise money to extract funding for the company from shorts who are still kicking the can down the road with these internalized trades or synthetic positions. Yeah, Roaring Kitty sent out this Time U cover and perhaps caught a few of these shorts with their pants down. As I said, could be the case, right? Earlier this week, I said, man, like these guys got to be careful if they really push us in here, if they use all these positions and they don't actually exit their positions. Go back, go read my post from Tuesday or Wednesday. I forget who it was. Somebody under my post. I was like, they got to be careful. If somebody comes in here, you know, a bullish institution, whatever it is, decides that they want to drop, you know, a few million, they could catch these guys with their pants down. And that's what Roaring Kitty exactly did. So probably the Thanksgiving shorts, right? Friday shorts did not have to exit their positions because they started shorting that back up at like maybe some of them. I don't know. I mean, we went all the way up almost to 31 again. They actually, yeah, no, basically everybody who entered into a short position from the day after Thanksgiving into now, you know, maybe some of them held their positions, but definitely Monday shorts got stuck in their positions. They had to buy to cover immediately. Anybody who sold short calls all throughout there had to cover their positions, especially if they're farther out, right? That's where you get the risk. You know, selling short calls, like you can sell something way out of the money. You can do that if you know the gamma data, if you got a good eye on the technicals, like you can do that and you can get some premium. But like if you start to sell stuff, like especially if you're in a bull trend and you think GameStop could go to like $50, like don't be selling $28 calls that expire in like a month because like this stuff can happen, you know? Yeah, definitely he pulled this. Okay, now the last thing, right? So what I do want to say, though, all of this is exciting, right? This is some, you know, extended consideration on this particular part of what's going on with Roaring Kitty. But look, this doesn't necessarily mean that the stock is just going to pump today. It doesn't mean that it's going to, it could go up into earnings, but like, let's be real here. And, you know, let's pay attention to the fact that, listen, there's still 1 million shares out there that are available to borrow. Okay, you can do some serious damage if you target the right times, you know, with 1 million shares. We have moved in. So if we go down, we look at our options data, you know, we are moving back into these stable trading conditions in terms of market maker gamma exposure, right? This big call dominant area, right? Stable trading, lower volatility, right? When we're thinking call gamma exposure dominant positions, we're thinking trading that is volatility suppressant. We're looking at, right? So as the price moves in any particular direction, if you got call gamma all through here, it means that as the price moves up, it means that gamma values are going down for strikes that go in the money. Gamma values go down. So then market makers are selling gamma hedges as that gamma gets realized. As delta moves up, so they sell their gamma hedges. So as the price moves up, they sell share hedges into that gamma depreciation, and it equalizes some of the pressure. But then as it goes back, gamma goes back up. Then as the price goes down, they start buying back gamma hedges to hedge that price going back in the other direction. Okay, right? So you get this equalizing effect. And the more call gamma you have on the map, right, the more sort of that's static and on the board, not necessarily new gamma. As new gamma gets put on the board, that's different, right? Market makers not only have to go out and gamma hedge that position, they got to go out and delta hedge that position. They got to do that whole thing. So that's causing them, you know, buying sentiment in the options market causes buying sentiment, period, on the part of market makers and their hedging and their hedging strategies, right? But it's right once these calls are on the board and no new calls are being added, then these sort of volatility suppressant properties come in. So as we're looking at it now, right? I mean, we can even go look at what the stock's basically doing. Yeah. looks, yeah, we're basically trading in this range. What I said in the post that I thought, probably what market makers would want to see. We've got this nice concentration here, basically between 28 and 29. Bulls are probably in control enough now. There's probably enough positive sentiment that, not enough ability to short the stock to really comfortably, safely get it back into this kind of 26, 27 area, which is more neutral. It's certainly reduced in terms of its negativity, its put dominant gamma exposure characteristics. So, I would say probably, like, if market makers could have their cake and eat it too, their max pain for today is around $27. That's just based on open interest. That's not necessarily based on directionality, like the sentiment of, what side of the trade they're actually occupying. But, it's probably a good ballpark figure for where their optimal profitability point lies. So, I would say they really are not going to want this $30 call position to go in the money. If we get too close to that, if that pushes over that, like, they have to deliver on a lot of shares. And probably if we're trading around 29, 28.50, like, those $30 calls probably have a delta of, like, I don't know, probably around 50 on them. Let's look at the 6th of December. Maybe around 50. Yeah. I'm wrong. Actually, they're way lower. Oh, but it's running around quite a bit. Yeah, well, we're pretty much down there. If on the approach to 30, like, if we're on a pretty interesting approach to 30, they're going to go up to 50. Those things go into the money, right? It becomes one. So down here around 28.50, they're only holding like 15% of the share hedges that they would need to in order to deliver on that position. So we have 10,000 contracts there. So that represents 1 million shares. Right now, they're holding probably like 150,000 shares to hedge that position, ideally. If we close at 30, that means between now and then, like, that means that they're going to have to pick up another 850,000 shares to cover that position. They're not going to want to do that, right? They don't want to buy shares. Like, and because the probability that $30 contract is going to go in the money is low, right? They're not, like, you move a little bit toward the end of the day, you move a little bit out of the money, like, that probability gets really affected. You move into the money, it gets affected pretty dramatically. So, like, they're swinging shares back and forth. If those close in the money, like, they really want to bet on that not being the case. So my assumption here, right, my hypothesis, let's say, with what they'll want to do is they'll want to basically keep us trading in these two pretty big call gamma positions. So $28, $29. It's might zigzag and forth, kind of back and forth in there a bit. If they can get it sort of lower in that range, right, they'd obviously like it to close as low as possible. But if they move too low, too early, right, we have enough gamma kind of concentrated here, call gamma concentrated here. I don't know, maybe Roaring Kitty wants to come in with another tweet. Maybe a bullish institution wants to come and, I don't know, drop a cool few million in the options market and can just shoot that sucker right up. And then that's really going to not look great toward the end of the day if all of a sudden, you're calculating the probability of the 30s being out of the money as, like, 90 something percent. And so you've only got 5% of your shares hedged. And then you got to go out with your cash and you got to pick up shares at, $29.50 or $30 or even above $30 to hedge a $30 call position. Like, you don't want to do that if you're a dealer. That's not what you want. So keep this in mind. I'm keeping this in mind for today, that this is not what's wanted. So that's kind of what I'm expecting here. Obviously, always a chance for the unexpected. But then, so if we look a little, oops, let's go back. Did I get rid of the? Oh, it's just a full screen thing here. Let's see. Right. So we still have this dynamic in the IV going into next week. So I've been talking about this a lot. And basically, like what we've seen is we've seen this. You'll see this on a lot of stocks actually, and it actually won't show up. You won't see this very clearly if you are just working through your broker. It looks like a pretty like kind of flat, gradual line. How they like tell you what the what the IV is, across charts and stuff like that. But if you go, this is one of the subscriptions that I have is Alpha Quarry. Somebody actually pointed this out to me on Superstonk this summer. This is how I found this. Somebody saw sort of the parallel between this and what was it, the Thumper meme. I also talked about that in the post, my other article that I referenced on like Roaring Kitty's strategy with this stuff. And so you can see here, right, like prior to the 2021 sneeze, like this big moment we had in early 2021, right? GameStop was following this pretty common sort of IV spike. So like this 2 week, they're all about 2 weeks long, right? About 10 trading days. When earnings is announced, there's an IV appreciation uptrend that happens just sort of because earnings is coming up. And if you know this pattern, like you can make a lot of money off of selling IV into earnings because earnings always comes down, which means that especially out of the money calls, which there's always usually more calls than puts, right? Out of the money calls are going to get smacked. I mean, puts will get as well, but calls especially will get smacked by IV crush immediately afterwards. They'll get smacked if the price goes down with that IV crush after earnings. And the decrease in IV and the decrease in price end up also crushing the delta values on those contracts. So then you get market makers selling share delta hedges on those out of the money calls so that you just get all of this premium that's all built up, right? Anticipation into earnings, all of this premium, this big souffle in the derivatives market just goes whoop right after earnings and into the pockets of whoever sold those calls, which, by the way, is usually the market makers themselves. So market makers also have a vested interest in seeing this pattern play out around earnings, right? We saw it disrupted in 2022 and 2023, right? Very different environment. Too much noise, basically, in the standard implied volatility values of most GameStop options contracts to be able to like figure out, like too much noise to be able to discern this. But beginning in 2023, we saw this pattern reemerge. It was even present like in this huge up move in May and June. Like we even had a 2 week period, right? That second spike. It's actually pretty curious to me. I'm not exactly sure to what degree this second spike was just the result of the anticipation of this particular earnings IV appreciation, and Roaring Kitty also knowing that was going to happen, right? Kiko also knowing that was going to happen when he revealed this $120,020 call position, which he entered in at like when the stock went down to $17 after that first big spike. So we saw this again at the Q2 earnings report, and we are seeing something like that now, right? I was curious how much of it was actually going on as a result of just our upward price movement in general. It's been, as you can see, right, if we look at this more locally, right, you can see these spikes as a result of just options, large numbers of call options being traded and the price moving up very quickly because of high volume of market maker share hedging, right? Market maker buying pressure to hedge this high volume of calls, especially, but short puts as well. Most of the puts that we were looking at being sold throughout this period were short puts. So if you buy a long call or sell a short put, market makers got to go out and hedge those positions with long shares. Either way, the market maker themselves has to go out and buy those. So we were definitely the past few days, despite the fact we saw the price go down, despite the fact we saw volume reduce to a trickle, despite the fact we saw options volume reduce and options premium value reduce. Look at that, right? We still see IV ticking up, and we saw the effects of that take place yesterday. too, right? So an up move significantly affected the degree to which IV continued to there's a higher baseline because of this sort of earnings period appreciation effect. And we saw it tick up quite significantly in reaction to all that buying from those algorithms yesterday. So what happens on this trend? You can go back. I would definitely recommend going back and sort of checking out what happened around quarter two, because that's that phenomenon in sort of in a range bound, or I should say around the quarter two earnings report, so around September 10th. That will show you what that looked like in a range bound trading scenario. Although we did have this kind of excitement to push the price up to 25. We had 2 Friday big gamma runs, call gamma squeezes on Friday. One of them happened just by organic, institutional activity, buying up a bunch of call options and selling up. Actually, it started with selling a ton of short puts. Was actually how it was. That was on August 27th, and then on September 6th, we had the Andy dropping Woody with the face of a dog tweet from Keith that then algorithms bought up and sent the price way up. So yeah, you can see what that looked like then, but we're looking at something similar now, and I don't want to say, like, I don't know. Oh, they're gonna, the price is definitely gonna go down. But the price is probably, like, if I'm looking back on these, I'm saying, okay, it's likely the price is going to go down. There's going to be an IV crush, right? Even if IV stays up versus, it doesn't necessarily go all the way back down to like 70% or 69%, 68%, like we saw, mid-October before the beginning of this run. It's going to go. If we see a price movement down, unlike what we saw a few days ago, IV is going to go down farther with it without the appreciative effect of earnings there around it. So, I mean, again, I don't know this 100% for sure. I don't know if market makers, brokerages who determine implied volatility in these contracts, if they're going to uphold this, if there's some other event that they think is going to happen. Like, do they price in thinking there's going to be a 13D filing by somebody on December 21st or something? I have no idea. I have no idea if that's going to happen. But keep in mind, I'm saying is, like, it's important to keep this dynamic in mind, right? Because you could go and you could buy calls today because you're excited because you're $28. Oh, that's, it could go to 30. And then when you see Monday, it's $30. We're back $31. And then you're like, okay, but even if it gets shorted back down to like 27 or 28, and I've got a December call, like, that could be fine. It's like, no, if there's an IV crush, like, your call's done. Like, even if the price were to go back to where it was, the IV level won't. So your call will have less time value in it. It'll have less theta, that is, right? It'll have less implied volatility in it, less vega. And that means the delta on it's going to be lower. So all of those things combined are going to mean that even if it goes back to the same intrinsic value, if it had an intrinsic value or if it was an out-of-the-money contract, it's not going to go back to the same that it was. Like, you need a much bigger price swing in order to make that worth it. So just, I don't like to. I tried this a bunch, like, back 2021. Like, I was swinging calls around, long calls around all over the place. It's just, they're designed for you to lose. I say this all the time in my posts. They are designed for you to lose. Most of them, by design, expire out of the money, worthless. Nobody makes money but the market maker. So, just keep this stuff in mind. Is all I'm saying. Not financial advice, but consider the risks. I think I'm allowed to say that. I think I'm still allowed to say that. So going forward, right? What does this mean for us? Certainly the integrity of our bull trend is reaffirmed. Roaring Kitty probably now has made or preserved the potential for Ryan Cohen to raise additional tens or maybe even hundreds of millions of dollars of equity for the company, of capital for the company as a result of dropping this post. So that's at least my hypothesis. Like, I don't know anything. Right? Oh, excuse me. I don't know anything. I'm not a finance guy. Like, I have no education in finance. I was educated in history and Renaissance studies. That's what my PhD is in. I mean, maybe I'll make a video too about why actually I think that this connects to my interests. It might seem a bit strange and far afield, but definitely a lot of my interest in this is understanding the dynamics behind this, understanding how the market actually works, also understanding these people that commit financial crimes every day and following this saga. So yeah, that's gonna bring the breakdown to a close today. As I said, I'm going to be following up with these types of breakdowns, daily every time I do a post. So I might, do some more less structured, less sort of detailed breakdowns like over the weekend. Maybe talk about some other educational topics in terms of what's going on with market mechanics, or maybe talk about how I came to figure some of this stuff out or develop some of my working models for trading. If that's interesting to you, make sure you leave a comment. Feedback's always welcome. Thanks very much, guys. Let's go GME, and we'll see you guys next time.